Hey there, my name is James Lee. Welcome to 5149, where I make videos about business, politics, and society. If you enjoy my videos, you can support me by liking, sharing, and subscribing to my channel. It really helps me out. Okay, today I want to talk about taxes. Taxes, I know, but I think it is worthwhile to explore a proposal that's been around for a long time, something called a financial transaction tax. Like we have taxes on various goods and services purchased. It would essentially be a tax on Wall Street, specifically a tax on buying and selling a stock, bond, or other financial contract like options and derivatives. There have been a number of different proposals in the past, but the most recent bill sponsored by Congressman Peter DeFazio of Oregon, called the Wall Street Tax Act, would tax the sale of stocks, bonds, and derivatives at 0.1%, 10 basis points, and would raise an estimated $777 billion over a decade. And just as a point of reference, a stock trade of $1,000 under this new tax policy would incur a tax of just $1. Now, why would we want such a tax? Well, proponents of financial transaction taxes say it's a way to cut down on speculative behavior in the stock market and raise revenue to boot. A tax on financial transactions would cut down on the type of speculation and rent-seeking that high-frequency traders engage in, and potentially cut down on the destabilization some say they cause in the market. So would this tax work? Because to me, it makes a lot of sense to impose a cost on high-frequency trading, which I think we can all agree on is not a good practice and something that benefits only the Wall Street elites. But in practice, like most things, it's not that simple. So stick around, and I'm going to try to break it all down. Like I mentioned before, this isn't a new concept at all. In fact, many countries around the world already levy some form of a financial transaction tax with mixed results. And that's the first thing I'm going to address, the revenue side. The $777 billion over 10 years I just mentioned, I would definitely take that with a grain of salt, because trading behaviors and volumes will inevitably change once a new tax is enacted. But the revenue opportunity won't be insignificant either. In the UK, their form of a financial transaction tax, known as the stamp duty reserve tax, which taxes stocks and shares and other liable securities, generates around £3.5 billion annually, or about 4.8 billion US dollars. And just for reference, the size of the London Stock Exchange is about 1/10 of the size of the New York Stock Exchange. Okay, so besides some of the uncertainty with revenue, what are the other downsides? Because new taxes oftentimes have unforeseen consequences. And I think it almost always comes down to how we implement such a tax to determine success, which is why there's so much room for Wall Street and other people to inject a bunch of propaganda and discourse and muddy the water in the conversation. Some of the most common arguments made by economic experts are that a financial transaction tax would drive down stock prices, making capital more expensive for firms, and increase the bid-ask spread, which reduces market liquidity and increased volatility. And they always point to Sweden. They love to cite how when Sweden began taxing financial transactions in the 1980s, bond trading fell by 85% and futures trading fell by 98%, and that the tax was declared a failure and repealed in 1991. That is all true, but they conveniently forget to mention that Sweden's tax policy had a major flaw. Tax Foundation economist Kyle Parmelow explained that it had an obvious massive loophole, which is that Swedish traders could migrate to the London Stock Exchange to avoid the tax, which they did until it was eventually abolished. On the other hand, the UK's financial transaction tax has been much more successful. In 1694, King William III levied a stamp duty on all paper transactions, and a version of that levy still exists today, taxing many stock trades at 0.5%. Unlike the defunct Swedish tax, it applies to trades of shares of any UK company regardless where traders are based. And when France in 2012 introduced a tax on financial transactions, a study from the European Commission found that trading volumes declined slightly, but share prices and volatility weren't meaningfully harmed. So details in how tax codes are written are extremely important in determining whether it ends up accomplishing what the original intent was. And moving on to my favorite argument that they make is that a financial transaction tax would be devastating for Main Street investors.
Well, I think the key impact to keep in mind here is that this would have a devastating impact on Main Street investors saving for retirement.
So how does that work exactly? If I take my money and put it in a 401k and I leave it for 30 years, I mean, how many transactions are there? Am I really trading in and out all the time? Because I only get the tax if I'm buying or selling something.
Sure. So if you're invested in a 401k, there is a turnover in those assets. There's a turnover rate. And our study found that over a lifetime, if you have $100,000 in your 401k, the estimated cost would be $64,000 over 40 years for a financial transaction tax.
She is so smug. It's going to cost hardworking people $64,000. We need to stop that. Well, I looked up this study that her organization put out, and here's how they came up with that number. The study stated under this type of tax, for every $100,000 of assets in a 401k plan, the saver would owe $281 in FTT taxes in a given year. And then over a 40-year time horizon, paying in at $281 a year at 7% annual growth, the average for pension funds, that this would yield a total value of $64,232 after 40 years. A couple things I want to say about that. First off, the way she put it was very misleading for a number of reasons. She made it seem like for every $100,000, we would need to pay $64,000 in taxes. Or at least that's what I first thought when I heard that. But that's not correct. What she's actually saying is that if you put $100,000 a year into your 401k, you would be paying approximately $281 in taxes for that $100,000. And if you had instead invested that money every year in a fund with 7% interest, that amount would add up to about $64,000 after 40 years. Second point I want to make, just to reiterate that again, the calculation in this study assumes that you're putting in $100,000 into your 401k every year. I don't know about you, but I can't put $100,000 in my 401k plan every year. Very few people can. A more accurate estimate on how this would actually impact the average retirement savings is to look at the median income, which is around $52,000 a year, with an estimated $5,000 contribution into a 401k annually, which is around 10% of your gross pay based on commonly accepted financial planning advice. So the average person would only pay about $13 in FTT taxes in a given year. These people are extremely tricky, and their logic is also extremely flawed because we pay taxes all the time. It's like saying, oh, if I didn't have to pay an income tax, I would be able to put all that money away and be up like $1 million when I retire. So that entire study is designed by Wall Street to fool people into thinking that their retirement funds would be massively impacted by this tax when that's really not the case. Let me just say this, the US in its current state is ultra capitalistic. Everyone acts in their own best interest, and that interest is almost always driven by money. So I don't buy the BS that Wall Street is looking out for Main Street. Not for a second. I mean, there's a reason why most of these claims about how devastating a financial transaction tax would be for the economy and for society are all from major banks, hedge funds, traders, or Wall Street think tanks. And if it really was that bad for pensions and retirement funds, I would expect major unions to say something or do something to oppose this tax and protect their members' retirement funds. You know what? I'm going to Google it. Major unions oppose financial transaction tax. Financial groups oppose it, business groups oppose it, Wall Street astroturfing Democratic candidates. Unions, nothing. In fact, in 2019, two major unions, the AFL-CIO and the UAW, were two of 61 groups who banded together to write a letter to Congress urging them to pass a financial transaction tax on Wall Street, writing that establishing an FTT would decrease volatile, high-frequency trading, refocus investment on Main Street, and grow revenue via a progressive tax. I'm telling you, if this really is bad for workers and pensions, union leaders and major worker groups would be all over this. The fact that they all explicitly support this tax while Robinhood, a trading app that markets itself as democratizing trading but actually sells its user data to hedge funds, has now joined other Wall Street firms in lobbying against such a tax, should tell you everything you need to know. I mean, I'm always up for having a conversation about taxes, the merits of a tax, how the government oftentimes misuses your tax dollars, so why create a new tax at all? That's all fair, but do not let Wall Street or members of Congress who are in the pockets of Wall Street Jedi mind trick you here, or more accurately, Senator Palpatine you into believing that somehow they have your best interest in mind, because they don't. That's it for today. Thank you so much for watching. I hope you had fun talking tax with me. I would love to hear your opinions on a potential financial transaction tax, so don't be shy about sharing your thoughts in the comments below. Also be sure to like, share, subscribe, do the notification bell thing. Your support means so much to me. My name is James Lee. I appreciate your time, and I'll see you next week.